You know that feeling? It's 2 a.m., you're lying in bed, and you just have to check. You grab your phone, squint against the harsh blue light, and you open your investing app. You swipe over to your portfolio, and for a second, you just stare at it. Maybe the line is green, maybe it's red, but honestly, that's not the part that stresses you out. The stress comes from the fact that your entire financial life feels fragile. You've been listening to the gurus. You've been watching the videos. You know you're supposed to be in the market. You know you're supposed to let compound interest do its thing. So you did it. You put 90% of your savings into index funds and tech stocks. And on paper, you're doing everything right. But in reality, you feel like you're walking on a tightrope without a net. Every time the news mentions a recession or a market correction, your stomach drops. You wonder, what if I lose my job? What if the market crashes now? I can't sell this money without locking in huge losses, but I also can't access it if my car breaks down. It feels like everyone is yelling at you to put your money to work, but nobody is telling you what happens if you actually need that money to work for you today, right now, for an emergency. It's a weird kind of trap, isn't it? You feel guilty for having cash sitting in the bank because inflation is eating it alive, but you feel terrified having it all in the market because one bad tweet from a CEO could vaporize half of it. My name is Mac, and I spend way too much time thinking about money, financial psychology, and why some people seem to effortlessly build wealth while others stay stuck in the same financial patterns for decades. And lately, I've been obsessed with this specific contradiction. Why is it that the people we look up to, the billionaires, the hedge fund managers, the ultra-wealthy, they all preach the gospel of long-term investing to the masses, yet when you look at their own personal balance sheets, they're often sitting on massive piles of cash. We're talking billions of dollars in liquid assets, just gathering dust. It doesn't make sense on the surface. If the market is the greatest wealth-building tool in history, why do the richest people on Earth refuse to keep all their money in it? Are they hypocrites? Do they know something we don't? Or is the advice they give the public different from the advice they follow themselves? That's what we're going to unpack today. Because once you understand why the rich hold cash, it completely changes how you view your own finances. It moves you from that fragile tightrope walk to standing on solid ground. It's not about avoiding the market. It's about understanding that the game the wealthy play is about power, options, and sleep, not just maximizing a percentage return on a spreadsheet. And I think by the end of this, you're going to realize that maybe having that cash isn't a mistake. It's actually your biggest competitive advantage. So, let's start by addressing the elephant in the room. If you ask the average financial advisor, or honestly, if you watch most finance videos on YouTube, the message is pretty clear. Cash is trash. Cash is a losing asset. Inflation is the enemy. And if you're holding dollars, you're losing purchasing power every single day. And mathematically, they aren't wrong. If you put $10,000 under your mattress for 10 years, it will buy you significantly less 10 years from now than it will today. That is a fact. But here's the thing the wealthy understand that the average investor often misses. Financial success isn't just about math. It's about psychology, and it's about mechanics. Let's talk about the mechanics first. The biggest reason wealthy people hold massive amounts of cash is because they view cash differently. You and I might look at cash as, well, money. Money to spend. Money to save. But the wealthy look at cash as a call option on every asset class in the world. Okay, stick with me here. I know that sounds a bit fancy, but it's actually a really simple concept if you break it down. In the financial world, a call option gives you the right, but not the obligation, to buy something at a specific price by a specific date. You pay a small fee for that option. If the price of the stock explodes, you make a fortune. If the price crashes, you just lose the small fee you paid. You're safe. Cash is basically a permanent call option that never expires. If you hold cash, you have the right, but not the obligation, to buy real estate when the market crashes. You have the option to buy stocks when everyone else is panic selling. You have the option to start a business when you see a gap in the market. I remember reading about Warren Buffett during the 2008 financial crisis. Everyone was panicking. The world was ending. Banks were failing. People were losing their homes. But Buffett, he had been sitting on a pile of cash, tens of billions of dollars, just waiting. He looked like a genius who had missed the run-up before the crash, but really, he was just waiting for the pitch he could hit. When a market finally hit rock bottom, he didn't have to sell his assets to survive. He didn't have to panic. He just reached into his pocket and bought entire companies at pennies on the dollar. He invested in Goldman Sachs and General Electric when they were desperate for capital. He made billions not because he was smarter than everyone else, but because he had the liquidity to act when no one else could. That's the secret. When you are 100% invested, you have no options. You are a hostage to the market. If the market goes up, you win. If it goes down, you lose, and there is absolutely nothing you can do about it. You just have to sit there and take it. But if you hold cash, you become the hunter. You're not hoping the market goes up. You're indifferent. If it goes up, great, your invested portfolio grows. If it goes down, great, you get to deploy your cash into undervalued assets. The wealthy don't hold cash because they expect it to make them rich. They hold cash so they don't go broke, and so they're ready to strike when the world gives them an opportunity. It's like having a full tank of gas and a spare tire in your car. You don't keep gas in your tank because you love the smell of gasoline. You keep it there so you can actually go somewhere when you decide to. And this brings me to the second, and honestly, probably more important point, the psychology of sleep. I think we vastly underestimate the emotional toll of being overinvested. I've seen it in friends, I've seen it in comment sections, and honestly, I've felt it myself. You put every extra dollar into the market, and then you check your portfolio 5 times a day. You get irritable. You get anxious. You start making decisions based on fear rather than logic. Maybe you sell at the bottom because you just can't take the stress anymore, locking in a loss that sets you back years. Rich people generally don't lose sleep over their net worth. And that's not just because they have a lot of zeros in their bank account. It's because they structure their finances so that their lifestyle is never dependent on the daily fluctuation of the stock market. They separate their living money from their investing money. There's a concept in psychology called locus of control. People who have an internal locus of control believe they have power over their lives. People with an external locus of control feel like victims of circumstance. When you are 100% invested in assets you can't control, your locus of control shifts to the external. The Federal Reserve, the president, the news cycle, they control your financial destiny. That is a terrifying way to live. Cash restores your internal locus of control. With cash, you have agency. You have a buffer. If you lose your job, you don't have to fire sell your stocks. You can pay your bills. You can take your time finding the right next opportunity. You can look your landlord in the eye and pay your rent without sweating. That peace of mind is worth more than the 2% or 3% inflation tax you're paying on that cash. It's an insurance policy against chaos. And honestly, chaos happens a lot more often than we like to admit. 2000, 2008, 2020. Things happen. Life happens. Cars break down. Roofs leak. Medical issues pop up. If all your money is tied up in a market, life's little inconveniences become major financial crises because you have to liquidate assets at the worst possible time to pay for them. Rich people use cash to turn life's emergencies into minor inconveniences. It's just a bump in the road. Now, here's where it gets a little controversial. Why do they tell us to invest, then? If cash is so great, why is the mainstream financial narrative constantly pushing buy and hold, and time in the market beats timing the market? Well, there are 2 reasons. One is benevolent, and one is, let's just say, structural. The benevolent reason is that for the average person, trying to time the market is a disaster. Most people are terrible investors. We buy when we feel good, which is usually when the market is at the top, and we sell when we are scared, which is when the market is at the bottom. If the average person tries to sit on cash and wait for the crash, they usually miss the recovery. They get scared, they stay on the sidelines too long, and they miss the massive gains that happen in the early stages of a recovery. So, for the vast majority of people, mindlessly dumping money into an index fund and forgetting about it actually is the best strategy. It protects them from their own worst instincts. The wealthy often have better discipline and better advisors, so they can afford to play the game differently. They have the emotional bandwidth to hold cash for 3 years without touching it. The average person sees cash in the bank and thinks, oh, I could buy a boat, or I can upgrade my kitchen. The temptation to spend liquid cash is high. So, locking it away in a market is a form of forced savings for many people. But the structural reason is a bit more cynical. The financial industry, the banks, the hedge funds, the advisors, they make money on assets under management. They don't make money when you hold cash in a high-yield savings account. They make money when that money is in the market generating fees and commissions. Think about it this way. Imagine you run a casino. Do you want people standing in the lobby holding onto their chips, or do you want them at the tables betting? You want them betting. The more chips in play, the more the house makes. The stock market is, in a way, a giant casino, and the financial institutions are the house. They need liquidity. They need buyers and sellers. If the wealthiest people who hold the most capital all pulled their money out and sat on cash, the market would collapse. Liquidity would dry up. So there's a massive PR machine dedicated to the idea that cash is trash. It's not necessarily a conspiracy. It's just that the ecosystem functions better when everyone is invested. The wealthy can afford to ignore this noise because they don't answer to a boss. They don't rely on a financial advisor who might drop them if their assets drop. And they don't need the market to go up in order to feel successful. They play a different game. This leads to another subtle point that I think is really fascinating. It's about speed and opportunity. We tend to think of investing as this slow, boring thing. And it is mostly, but real wealth, explosive wealth, is often created in moments of rapid, chaotic change. Let me give you a hypothetical example. Let's say there's a neighborhood you've been watching. You love it. You know it's undervalued. But houses are going for $500,000, which is just too expensive for you to get a good return on a rental. You're priced out, but you've been holding cash. You're patient. Then, suddenly, there's a local recession. A factory shuts down. Panic sets in. People need to move now. 3 houses on that street go up for sale in a fire sale. Someone needs to sell in 30 days, or they go into foreclosure. If you're 100% invested in stocks, and the stock market is also down, which it often is when the economy is bad, you can't buy that house. You have to sell your stocks a loss to get the cash, which hurts, or you have to take out a loan, which eats your margins. But if you have cash, you walk in, you make a lowball offer, maybe $350,000, and you close in 14 days. You just bought an asset at a 30% discount because you had the cash to move fast. This happens in the stock market too. During the dot-com crash, during the financial crisis, and even during the COVID dip, there were companies with solid businesses that saw their stock prices halve for absolutely no reason other than panic. The people with cash bought Amazon or Apple or Google for 50% off. The people who are already fully invested just watch their portfolio shrink. Cash buys you the ability to be a vulture. And honestly, in the world of finance, being a vulture is a good thing. You're cleaning up the mess, providing liquidity to people who desperately need it, and you're getting paid handsomely for it. But you can't be a vulture if you have no ammunition. You're just another carcass on the side of the road. I want to pause here for a second and make sure we aren't getting confused. I'm not telling you to sell everything you own and put under your mattress. That's foolish. Inflation is real, and the stock market has historically gone up over long periods. If you keep all your money in cash for 40 years, you will retire poor. That is not the plan. The strategy of the wealthy is about allocation. It's not cash versus stocks. It is cash and stocks. It's about finding the right balance for your life, not for a spreadsheet. Maybe for you, that means keeping 20% of your net worth in cash or cash equivalents. Maybe it's 10%. Maybe if you're nearing retirement or have a high risk tolerance for chaos, it's even 30% or 40%. The goal isn't to maximize the theoretical return on your money according to a calculator. The goal is to maximize your actual wealth in the real world, where things break, people lose jobs, and markets crash every few years. There's a quote from the investor Howard Marks that I love. He says, "Money can't buy you happiness, but I'd rather be crying in my Ferrari." And sure, that's funny. But when it comes to financial strategy, I'd tweak it a little. I'd say, I'd rather be holding cash in a crash than praying my stocks don't go to zero. It's about the difference between looking rich and being wealthy. Looking rich is having a portfolio full of tech stocks that are up 50% this year. Being wealthy is knowing that if your boss calls you into his office on Friday and fires you, you don't have to check your brokerage account to see if you can afford your mortgage this month. You just transfer the money from your savings account. That is power. That is freedom. And let's be real about something else. There's a dark side to leverage. A lot of people try to get rich by borrowing money to invest. They use margin accounts. They leverage their real estate. And when things go well, they look like geniuses. But leverage is a double-edged sword. If you borrow money to invest and the market drops 30%, you don't just lose 30%. You can lose everything. You get a margin call. The bank forces you to sell at the bottom. Rich people hate leverage. They might use it for business deals where they can control the outcome, but for their personal wealth, they prefer equity. They prefer owning things outright. And cash is the ultimate anti-leverage. It's a cushion against any liability. If you have no debt and a pile of cash, you are bulletproof. You can survive an economic apocalypse that wipes out highly leveraged geniuses. This brings us back to the psychological aspect, specifically the concept of fear of missing out, or FOMO. I think FOMO is what drives most people to be 100% invested. We see the S&P 500 going up, and we think, if I'm not in this, I'm an idiot. We see our friends making money on crypto or AI stocks, and we feel like we're leaving money on the table by sitting in cash earning 4% or 5% interest. But wealthy people have a different relationship with FOMO. They aren't afraid of missing the upside. They are afraid of participating in the downside. They understand that the market moves like a staircase going up and an elevator going down. It takes years to build wealth, but it can be wiped out in weeks. They are willing to trade the potential for a slightly higher return for the certainty of safety. It's like walking through a minefield. The average investor is sprinting across the field, trying to get to the other side as fast as possible to get the prize. The wealthy investor is walking slowly, carefully, maybe even using a metal detector, checking every step. They might get to the other side later, but they're actually going to get there. The sprinter might get blown up halfway across. And there's a fascinating behavioral study that shows that the pain of losing money is psychologically about twice as intense as the pleasure of gaining the same amount of money. If you find $100 on the street, you're happy. If you lose $100 from your pocket, you're furious. The emotional impact isn't equal. Losing hurts more than winning feels good. Wealthy people understand this intuitively. They structure their lives to minimize the pain of loss. They don't take the bet unless the odds are heavily in their favor. Keeping cash is a way to minimize the pain of loss because you're never forced to sell at a loss. You never have to experience that agony of realizing you've lost years of hard work because of a market dip. You control the exit. I also want to touch on the concept of velocity. Money needs to move to create value, but it needs to move intelligently. Cash sitting in a bank isn't dead, as the critics say. It's potential energy. It's a dam holding back a river. As long as the dam is there, the water isn't turning the turbines, so it's not generating electricity. But the second you break the dam in the right place at the right time, that water rushes through with incredible force. If you deploy cash into a business, or a rental property, or a stock at the absolute bottom, the velocity of your wealth creation is insane. You make 5 years of progress in 5 months. But you can only do that if you've built the dam first. Most people are trying to run a hydroelectric plant without a reservoir. They're just hoping the rain falls exactly when they need it. Rich people build the reservoir. They hoard the water. They wait. And when the drought comes and everyone else is dry, they open the floodgates and they own the town. So what does this mean for you? How do you apply this rich person logic to a normal, everyday life? First, stop feeling guilty about your savings account. If you have $10,000, $20,000, or $50,000 sitting in cash, don't let the internet shame you into thinking you're failing. You are succeeding. You are building your dam. You are buying yourself options. You are buying yourself sleep at night. Second, define your number. Not your retirement number, but your sleep number. How much cash do you need to have in the bank to feel calm? Is it 6 months of expenses? Is it a year? Is it 2 years? Figure that out and protect that pile of cash with your life. Treat it like an asset, not an afterthought. It is the foundation of your financial house. You can't build the penthouse suite if the basement is crumbling. Third, shift your mindset from investor to buyer. Most people just throw money at whatever the market is selling. They buy index funds. They buy whatever is popular. A rich person waits for a specific opportunity. Maybe it's a specific piece of real estate. Maybe it's a business they want to start. Maybe it's a stock they've been watching for years. Keep a buy list. Write down the things you would love to own if the price was right. And then, when the market dips or you find a bargain, use your cash to buy that specific thing. Don't just buy because you have money. Buy because the deal is good. And finally, accept that you might look boring. You might miss out on the latest meme coin craze. Your friends might brag about their crypto gains while you're sitting there with your boring savings account and your diversified ETFs. Let them brag. Wealth is quiet. Wealth is boring. The people screaming about their gains are usually the ones screaming about their losses a year later. There's a famous phrase: the market can remain irrational longer than you can remain solvent. That is the ultimate warning against ignoring cash. If you're fully invested and the market goes irrational, if it goes down and stays down for 5 years, you're forced to wait out, hoping and praying it comes back. If you have cash, you don't care if the market is irrational. You can sit on the sidelines, sipping your coffee, watching the chaos unfold, completely safe, waiting for the moment rationality returns. That's the position of power. That's the position the wealthy occupy. And it's a position you can occupy too, starting today. It doesn't require $1 billion. It just requires a shift in perspective. It requires realizing that cash isn't the enemy of wealth. Cash is the bodyguard of wealth. It's the thing that stands at the door and makes sure everything you've worked for doesn't get stolen by the next market crash or economic downturn. So, as we wrap this up, I want you to take a deep breath and look at your own situation differently. Forget the guilt. Forget the pressure to be 100% optimized at all times. Life isn't a spreadsheet, and neither is your money. The wealthy hold cash because they know that the game isn't just about how much you can make. It's about how much you can keep and how long you can stay in the game. They tell others to invest because the system needs participants, and because for most people, discipline is the hardest part. But now that you know the why, you can make a different choice. You can choose to build a fortress around your finances. You can choose to hold enough cash that the next recession doesn't scare you. It excites you. You can be the person who is ready when opportunity knocks, instead of the person scrambling to find the door. Money is a tool, and cash is the sharpest tool in the shed when it comes to freedom. Use it that way. Don't let your money be a prisoner of the market. Let it be the commander of your destiny. Start viewing your savings account not as a loss, but as a reservoir of power. Because when the storm comes, and it always does, you're going to be really, really glad you built that dam. Thanks for hanging out with me and thinking through this. It's a complicated topic, but honestly, getting this right changes everything. Until next time, stay smart, stay liquid, and keep building.